The fund is a global all-maturity high-yield fund. We invest across all time periods and across all maturities within the high-yield spectrum. We have to stay 80% invested within high-yield at all times, but we do have the ability to invest up to 20% within investment grade. Sure, so the funds themselves are supported by a big team of analysts. The fund is predominantly bottom-up driven, so we have a team of analysts based in Europe and the US as well. So about 25 credit analysts in total we employ across Aegon Asset Management. And as those analysts give us ideas, we try and create portfolios which are differentiated versus the competition. And those differentiating factors are 5 things. One is high conviction, the other is bottom-up driven, we're index agnostic, we're global, and we're flexible. And those 5 things are what drive alpha in the fund. The 2 biggest risks are also our 2 biggest differentiators, and that is that we run a high conviction fund, so we limit ourselves to between 90 and 140 names in the portfolio at all times, and we're also index agnostic. The reason we want to be index agnostic is that we believe that as active managers, we're paid to take different bets from the benchmark, and to consistently beat the benchmark, you have to consistently look different from the benchmark, and that's our view. And so the key risks for the portfolio is we are going to be more concentrated than the average peer, and we're also going to look very different from the average peer as well. Yes, we do integrate ESG. We view that as an enhancement to returns. We don't view that as a detractor from returns. Ultimately, in high yield, it's about getting your money back. That's the most important thing. And so if we identify E, S, or G risks that puts that in doubt, then we want to know about it. And so ESG is very much integrated into the process. Yeah, high yield funds give great diversification versus other asset classes. It's lower in duration than traditional fixed income, but versus equities, it gives you all the return of equities, but it does it with a fraction of volatility. And so for clients either looking to de-risk their equities into high yield, they can do so without giving up the returns. Or for traditional fixed income investors, you can enhance your return but not take on that additional duration risk that other parts of fixed income offer.